Let's hit record. Okay, perfect. All rates actually look a little decent today. Alrighty. We're recording, we're ready to go. Perfect. So good morning, everybody. Happy Monday. Hope you had a great weekend. A lot of news kind of happened in the past 2 weeks. I know that the last time that we left off, we were talking about consumer price index was going to be coming out within the next couple of days. And it did. And it killed us. And it's kind of started the snowfall.
I don't need to be here.
It's kind of started the snowfall effect of higher rates. So we're actually going to be looking at the mortgage-backed securities today after, just to kind of see where they are, like how big of a impact we've had in the past couple of weeks. But really, it's been a free fall for the last month, and we're hoping that it comes to a halt when the new report comes out for consumer price indexes. I believe that the Fed is now going to go instead of 25 basis points to 50, and that's just going to hurt us a little bit more as well when it comes to mortgage bonds and bonds in general. But inflation increased by 0.5% in January, and even though it increased by 4.5% in January, it actually decreased year over year from 6.5 to 6.4%. However, rates still took a hit, and they did shoot up. Why? Because investors are essentially expecting these things, and if they don't happen, they basically overpriced their market, right? So they're buying, assuming or with the feel that inflation is kind of over and done with, which we also believe as well. But as soon as you get one inkling of bad news, now all of those bonds that were basically what we call priced in, right, with the assumption that that inflation is going to continue to come down, now all of those get sold off. And so now you start to see mortgage bonds kind of retract and go the opposite way, or bonds in general just go the opposite way. And that's exactly what happened. Even though inflation technically went down year over year by 0.1%, because it was higher than what expectations were, we saw a huge hit on interest rates. And the same thing happened with producer price index, and which is what measures inflation on the wholesale level. That came in above expectations as well, even though it also did decline year over year from 6.5% to 6%. We still saw hits on bonds that day because it's the same thing. It came in above expectations. They expected wholesale inflation to be lower than what it actually was. And that pretty much is what kills us, right? Is that they're assuming that these things are going to happen before they actually happen, and they price that in. Housing starts are also down big time. And these are homes being built via new construction. Right now, builders are on pace to make 1.406 million homes this year, while household formations, which are basically when a new household is formed, right? So when someone gets married, when you have kids and you're going to start a family and you're kind of moving into a new household, that's considered a household formation. This year, they're projected to be at 1.9 million. So we're still going to be short 500,000 homes by the end of this year in terms of when we're talking about household formations, which is typically the biggest statistic when you're looking at people buying homes, right? That's why I don't know if you guys have seen this this graph before with millennials, baby boomers, and it kind of shows when they turn 30 to 40, that's when those household formations typically start. It's kind of that thing. Housing market index is getting much better. We're almost back to 50. Remember, at one point we were like in the 30s. I think it was like 35, 33 was the lowest. The National Association of Home Builders showed their builder confidence is continuing to increase, and it came in at 42. Remember that benchmark is 50, right? So for home builders, anything below 50 means that they're contracting in the space, which is why they're not making so much homes compared to what the demand is. They're trying to protect themselves. But anything above 50 would mean that they're going to be, would signal expansion and they will be building more. And right now we're still on that contraction level at 42, but we're continuing to increase month by month since last year. Now, that was pretty much the news from 2 weeks ago. The news for last week was personal consumption expenditure, which is the Fed's favorite measure of inflation, came in at 0.6% in January. And this one did show an increase year over year from 5.3% to 5.4%. Remember, the Fed's number is 2, right? 2% is that number for them. Now, for those of you kind of unaware, with the different inflation numbers and kind of what they mean and things like that, right? So when we're talking about CPI and PPI, those measure the changes of price prices and goods. Okay, so consumer price index basically measures the change in pricing for on the consumer level for prices and goods. Producer price index measures the change of price and goods on the wholesale level. Okay, personal consumption expenditure is what people are actually spending in order to get these products in. Okay, that's really what the difference is. That's why PCE is so important, because it's actually showing the out-of-pocket cost for the consumer. Existing home sales fell 0.7% from December to January, and they're down 36.9% year over year. And these are resale sales. Okay, these are homes that are already built and they have an owner. It's most of the sales that we do down here in South Florida as well, right? While new home sales are new construction sales, and those rose 7.2% in January, and they're down only about half of what existing home sales are down year over year. So they're only down about 19.4%. And I don't think this is a coincidence. Sellers aren't really selling unless they have to. So you can kind of see that there's still demand there, right? Because if that home is being built, buyers are still getting into those homes. And I think also new construction, now that they have incentives back, and, you know, they're incentivizing clients with not only if, you know, Hometown Heroes, a lot of those builders may have that, but also credits from the seller and things like that. While on the flip side, existing homes, even though you're getting those credits, you're not really essentially seeing a lot of those on the market, because if sellers really only selling unless they absolutely have to, right? They're not just like it was in 2020, 2021. Hey, let me see what I can get for my house, and then I'll just upgrade from here because I'll be able to get a cheap payment or a cheaper payment than what I currently have. Last on market news, jobless claims are still not moving. Once they start to move, we'll look at the data again, but as of right now, they're pretty stagnant. And FHA did come out with some really big news last week. They're lowering their MI premiums from 0.85% to 0.55%. So basically, you know, if you've heard me talk in the past, you know that this is really the biggest way that we differentiate or give clients their options when it comes to loans, right? Because everything kind of falls down to that mortgage insurance payment. On conventional, you could do 3 or 5% down. FHA, you can do 3.5% down. The biggest difference is what the payment difference is, which falls into that mortgage insurance, because in the past, the rates would pretty much be right there. But with mortgage insurance, FHA has always been, you know, 0.85%. Doesn't matter if you're a 600 credit score or an 800 credit score. That's pretty much that mortgage insurance premium payment. With conventional, it does fluctuate depending on your credit score, right? So the higher your score, the lower your mortgage insurance payment typically is. And so we would see people that would be at 700, 720, 740, so on and so forth. They would benefit more by being on conventional because their mortgage insurance payment was lower. Now, I think we're getting into a new market, at least with mortgages specifically, where you really have to consider even 680, 700 borrowers and see if FHA is going to be more beneficial for them, because not only is that mortgage insurance payment decreasing for FHA, but conventional is basically increasing their loan level price adjustment. So now the rates are going to be different on conventional as well, right? Because now you're getting more hits, which you spoke about a couple of weeks ago on conventional loans. If you're a first-time home buyer and you're putting, 5% down, if you're above 40% DTI ratio, different things like that, they're dinging you for it on conventional, and that's going to essentially increase your rate. So FHA, at least moving forward, looks like it's going to be the best option. The only way that conventional typically will win, or not the only way, but some of the few ways that conventional would be the best option for borrowers, at least the ones that we typically deal with here, first-time home buyers, decent to high credit. I would say 660 to 700 is usually where our clients typically are, and they're first-time home buyers. The way that they'll benefit by going conventional is if they're low to medium area median income, because conventional waives their loan level price adjustments for them completely. So now you're talking about getting a better rate than FHA. And then also if they're above, 700, 720, 740, that would possibly be where conventional will still win over FHA. But right now, 680, 700, I think that FHA is going to win out in terms of what that mortgage payment is going to look like compared to compared to conventional, as well as that slightly lower down payment as well. So we'll be kind of taking a look at it. It's more work on our end right now that we have to kind of figure out what that soft spot or that sweet spot is. FHA is not endorsing these loans until March 20th, but we've already started. I believe it's already in our systems because it came out late on Friday. I actually have to double check and see, but they did come out with an email basically saying that we are already doing that 0.55% on FHA loans. So we're already going to be considering that when we're giving our pre-approvals now for the next month or so, hitting you or putting that mortgage insurance at 0.55%. So we're no longer, at least with Highlands, doing that 0.85 at all for FHA loans. Okay. Last thing I wanted to show you. Let's look at this together because market overview. Okay, perfect. These are bonds. So you can see here, guys, we're no longer in the at the 5.5% coupon. Remember, what I tell you guys is when you're looking at these coupons, 100 means that's the break-even point for a lender for what Wall Street's going to be buying that loan for. And you can see even now with that 6% coupon, if we were to see this, we're at 1.16. So that means that for a 6% interest rate, Wall Street is giving 1.16% to deliver that loan to them in the secondary market. Okay. Now, however, obviously that doesn't mean that a lender's doing 6% interest rate flat with no points, right? Because there is expenses that need to be paid. You can't cover the bills with 1.16, right? We know this even as realtors. So there's different things that kind of go into this that's going to put the average rate right now anywhere between with no points. I would say probably very, very high sixes, like 6.875, or very low 7 and an eighth, give or take, would be no points or very minimal points. If you're trying to get to that 6% as of today, you're going to see probably about 2 to 3 points mixed into that pricing. Okay, so rates have taken a huge hit. I think pretty much for the last, we're February 2nd, since the beginning of this month, we've literally just gotten bad news after bad news after bad news. It started with the employment report that came out early this month. That's when we took that big hit. And then when we got consumer price index a couple of weeks ago, when we got producer price index, when we got personal consumption expenditure last week, we've just been continuing to dip down here on these. There's a lot of room for us to have to come back in order for rates to be where people were like the most comfortable, I believe, within the past year and a half, where people were actually okay with getting that low 6, high 5 interest rate. We get creative and pay $10,000 from the seller and be able to get you to a 5.5, 5.3. Now that $10,000 as of today would probably get you to a 6.1, 6.2. So we pretty much have turned over almost a full point, I would say, within the past month. And this is the volatility that is really scary for a lot of people, even for us in our business, right? Because there's no certainty like there was in the past. Everything's really high, really low. And once the market starts stabilizing, whether it be here at that 6% coupon, whether it be at the 5.5% coupon, 5% coupon, whatever it is, once you see stability over a couple months, we saw it from November all the way through January. And that's when business started picking up for us, right? It's not for no reason. It's because consumers are saying, okay, rates are going to be here. This is where rates are. As soon as they shoot back up again like this and they start to hear the news, they're like, whoa, I thought rates were here. Now, if rates stay here for the next couple months at the 7s, even though they're relatively high, same thing's going to happen, right? People start to come back into the market. There's stability. They've heard 7% for 2-3 months. They need a house. They need to jump in, okay? This volatility is what's really the most worrisome when it comes to the market, because that's what is going to keep people away from purchasing, at least in my opinion. Okay. That's pretty much the news for today and last week as well. I don't know if you guys have any questions, any scenarios, or anything like that. Nothing that you guys came across. I know a couple of weeks ago, Lorraine said some ideas that she had. I don't know if anybody else came up with some ideas on how they're, utilizing and moving their business, how they're getting creative.
I'm finding, Mike, that on these deals, it's really about getting creative on the lending side so that it can put the buyer in a more comfortable spot. We definitely have entered into the season of stubborn sellers. And so the creativity has to come in from the finance side. And I'm talking about stubborn, where I see listings 168 days on the market and still no price reduction. So
Yeah, and
that's
on those, on those, typically I'll tell the realtor to just go in at value and just ask for cash back. That's the best thing. You don't want to lower the price point on that, and then the 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 appraisal comes back and it's already either at value. If it's at value on that lower price point, you're not going to be able to make some wiggle room for the seller to be able to give you some credits. I mean, it definitely depends on the seller, because I've seen both sides of it. I've seen coming in at value and getting credit. I've seen coming in way below value and still getting credit. I think it's the urgency from the seller, and why they're selling. A lot of deals that I'm seeing now are people that necessarily that they need to sell. They need to get rid of that home for whatever reason. Maybe they're going through some sort of pre-foreclosure. A lot of properties right now, or not properties, a lot of people have stopped their whatchamacallit. Damn, I can't even think of the word right now. They basically the deferments, right? They stop the deferments or their forbearances. And what happens is, when you're doing a forbearance as opposed to deferment, is the difference is that forbearance is the interest continues to still compile up, right? And so if you've done your forbearance for the past year and a half due to COVID or whatever the case is, that interest is now due whenever that forbearance stops. And sometimes that's $10,000, $12,000, $15,000. That client's most likely didn't save that money, right? And so even though we're not going to see that, I don't believe we're going to see that foreclosure of prices. We will see people selling their homes and they need to get rid of them before that foreclosure starts, because if not, they do have a listing agent that's telling them you're going to lose your equity. They might as well just get rid of it, and as quickly as they can, so they can get out of that foreclosure process before it starts and still get some appreciation, some equity from their house. I've seen that. I've seen probate, a lot of probate right now as well. People that have passed away in the past couple of years. Actually, now that I think about it, right, probates usually last a couple of years. So it could be people that unfortunately they died during the COVID time, and then that house is just getting settled in court, and now is when they're kind of coming into fruition in the market as well. Because I've seen probably in the last 3-4 months, I think I've closed about 3-4 deals from that, just straight up probate, and those people have died in the past couple of years. So we'll see more of those come into the market as well. But yeah, seller is only selling unless they absolutely have to. So just get to negotiating pretty much. I think that's really the only thing that we can kind of do. I think in terms of creativity for buyers, like I mentioned to you guys last time, it's very important to sit with them in our consultations, or in the consultations that you do with your lenders. I think it's very important for us to kind of gauge that client together. Whether it be me or somebody from my team that's doing a consultation, they kind of know more or less if someone is serious and how serious they are and how creative we can be. Right. Because I don't want to talk about getting seller credits if you're not comfortable, because you're the one that's actually going out and showing the properties, and that the feedback that you're getting. All right. So if I don't want to open up that kind of worms with you not being there, and then the client goes back to you and says, yeah, but let's, get $10,000, let's get 12, let's get 15. If we do that, kind of work that together and say, hey, you can get seller credit, but don't expect 10, 12, or 15. Expect, let's try to shoot for 5, 6. This is what it's going to do to help with your payment. This is what you're paying now, and kind of piggyback off of each other. Right. This year is going to be about that partnership with your lender. So I think it's going to be very, very important to kind of do that. We always send numbers before you go under contract. So please always send us those addresses so we can run the numbers for you and the clients before you go waste your time, put in an offer, draft it up, negotiate with the listing agent, and then go under contract, and then the client's not comfortable with that payment. Let's squash that up front, and try to be as completely and upfront as possible when it comes to these clients, because you need to be able to take on more clients. Okay, that's the number one thing, is you need to make it efficient for your business, right? Where you're not just focusing on this one client and getting them under contract. Obviously, you're going to do your job as a realtor, show them those properties, make sure that they're serious before anything, send those addresses, make sure that they're comfortable with the payments. Hey, did you see the closing cost worksheet that they sent you? Yeah. Are you good with it? Yeah. Okay. All right, let's go. We're going to see this property today so that way, if you like it, you go under contract, as opposed to not doing that, not CCing us on that initial email to the listing agent, going and selling the property, or going and showing the property to someone and or to that client, and then they get super excited, and then the numbers come after, and you just wasted gas, time, and other things that you could have been, prospecting. Other time that you could have been prospecting, maybe showing another client a property around that same time, different things like that. The number one thing I can tell you that I came across recently, and I told that realtor, do not ever do that again, is tell a client what their payment is going to be without talking to us. That is the worst thing you can do. Okay. Because then it makes you look bad, and then makes us look bad as well. Okay. That happened. He told her that her payment's going to be very, very cheap. It's going to be much cheaper than her renting right now. Got her super excited, and then got mad at us when the payment was relatively higher than what they expected. I was able to move some numbers around, thankfully, and get creative, right? Like Lorraine said, get creative to get that payment lower than what they expected it to be. But converse with us, ask us those questions, call the office and make sure, email us, make sure that those payments are going to be in line with what the client wants. That's why we release pre-approvals at what their budget is, right? I never really typically release a pre-approval at that client's max. I don't want to set you or them up for failure. Okay, so when we have that conversation with them, and we say, you're comfortable with 2,000, technically you can get approved for 3,000, right? Which 3,000 right now is anywhere between 350 to 400,000. But you're comfortable with 2,000. That's going to be about 285 to 300, give or take. That's where I'm going to release that pre-approval. So if that client comes back to you later and says, hey, this pre-approval is too low, and you call me, and I'm like, yeah, that's because that's where they want it to be budget wise. If they want to increase, they can, they have the room for it. I told them originally, but they were talking about what their payment was, because then the client, after looking for a month or 2 or 3, remember, they start to forget the conversations that we have with them, right? It's normal. And they're like, this pre-approval is too low. I'm going to go look for another lender. That other lender pre-approves them at 400. You go under contract with that other lender. And what happens? That payment's too high for them, right? So just about having that communication with us, utilize us as much as you can, me or the team, or your loan officer that you use, utilize them, and really make sure that they have your back, right? Because you do not want to waste time. This past week, there was a loan officer. She was up in the West Palm Beach area. I think in 2020, she sold like 17, I think it was like 16, 17 million, maybe 18. And she works at FP&L now. Okay. So if you're not taking your business serious, these things can happen to anybody, right? Realtors are self-employed, loan officers are self-employed. Make sure that you're utilizing your time right, not wasting too much time on your clients if they're not that serious, and prospecting as much as you can, because right now it's about getting as many clients as you can in order to be able to close deals, 1, 2, 3, 4 a month. You guys have any questions? I'm done. I'm done ranting.
No.
You guys good?
Yes, we are.
We are good.
Thank
Yeah,
you.
Mike, I did pop in a little later than usual. Where are we with the rate?
I'm sorry, what was that, Lorraine?
I'm sorry, I popped in a little late. You might have said it at the beginning. Where are we today with rates?
No points on a great borrower. 7 1/8, 7 1/4 on average.
OMG. Alrighty. Wow.
Yeah. We've been on a free fall since the beginning of February. I mean, hopefully we start to trend upward. Today's a good day for rates. But we have a long way to go from where we fell off in the beginning of the month.
Mike, did you say 7.8?
No, 7.125.
Oh, okay. All right, thank you.
No problem. All righty, y'all. Thank you. Have a good week. Anything you guys need, just give me a call, okay?
Okay, thank you, Mike. Thank
Thanks,
you.
Mike.